So what is up, guys? Welcome to Crypt-Economy, and today we are looking at index funds and ETFs, and probably even how you can think about navigating bear markets and recessions with the help of index funds as well as ETFs. So let's look at the difference first. Now, a few of you guys actually asked me this a couple of times, so let's talk about index funds first. Now, index mutual funds, guys, they are funds that represent a theoretical segment of the market and are designed to act as a performance and makeup of the financial market index. Now, this is a very complex form of saying that they track a very specific index in the market. So let's say Standard & Poor's 500 index, which is the S&P 500. So what does this index fund do? It tracks the top 500 companies in US, and that's the aim of this S&P 500 index. That's it. That's all it does. If let's say we look at the Russell 2000 index fund, that's the Vanguard Russell 2000 ETF. I'm taking this as an example here. It tracks the Russell 2000 index, which is collection of about 2000 of the smallest publicly traded companies in the US. So an index fund essentially can track very specific indexes, be it the top 500 companies, the bottom, or rather the smallest 2000 companies, the tech index, or something such as the QQQ, which is Invesco QQQ Trust ETF. Now, I'll get to this point in a quick second, but QQQ, for example, what it does is it tracks the performance of the largest non-financial companies in the NASDAQ 100 index. Now, right now, it comprises of about 48% tech stocks, because that's how it is. Top 100 companies. Within those top 100 companies, look at non-financial companies, and a major chunk of that are tech companies. Now, it also includes staples and other discretionary couple of companies as well, right? So this is the QQQ index. Now, you have tons of indexes, be it the S&P 500, which is the most common one. Then there's a total stock market index as well, which again, Vanguard has an ETF around that, which is, it consists of small, medium, and large companies across all sectors. So essentially, when you put money into an index fund, you get exposed to whatever that index is supposed to comprise. So S&P 500, so you get exposure to the 500 top companies in the US. Now, let's say you are looking at the Indian market per se, and you're looking at the Nifty 50 index, right? You'll find mutual funds, and you'll also find ETFs around that. Now, I'll get to the difference in a quick minute, but Nifty 50 will track top 50 biggest companies by market cap in India, and you get exposure to all of those 50 companies, no matter what those 50 companies are. Now, this is basically what an index does, or an index fund does. Now, in comparison, if you look at ETFs, guys, ETFs are baskets of assets that are traded like securities. Now, what does this mean? This means pretty simple, guys. Index mutual funds, they are usually traded, and their price, by the way, is calculated at the end of the trading day, not any time, right? When you withdraw your funds from an index mutual fund, it takes a day, couple of days, depending on which country you live in. Like if I talk about India, could very well be T plus 2 days, right? And if I look at the ETF, it is just traded as any stock would be through your normal brokerage account. Now, ETF can be bought and sold at any minute during the day, of course, of open market, just like regular stocks, right? So this provides us or rather ETFs, they provide us a bit more liquidity. Now, in terms of what is better out of index funds and ETFs in terms of fee, usually ETFs tend to have a lower fee as compared to mutual funds. But however, with that being said, guys, there are ETFs that track specific indexes as well. So you could very well use an ETF that tracks the S&P 500 index. The other way is not true. Now, an ETF can be an index ETF, or it can be a non-index ETF, a basket that actually comprises of very specific stocks, or even, by the way, ETFs can also track other funds. So it can be a fund of funds as well. And a lot of times this happens when we are talking about the foreign markets, right? So that's pretty interesting and pretty cool in terms of ETFs. In terms of choosing either one of these, doesn't matter if you're looking at a 10-year, 15-year investment horizon, doesn't matter which one you choose. Now, if you look at maybe a couple of examples. I've just talked about S&P 500 index. Now Vanguard, which is VOO, Vanguard has this S&P 500 ETF, a very, very popular ETF. This is actually an index ETF that tracks the top 500 stocks, or that tracks S&P 500. Now, in parallel, if I look at another one of my favorite ETFs, which is VDC, which again is by Vanguard. Now there's Fidelity, there's Vanguard. Vanguard is kind of generally loved a bit more from what I've seen. Now this one tracks consumer staples. Now let's look at bear markets, or let's look at bull markets. We all need food. We all need staples in our life. So usually the companies that are in staples, they tend to do okay in terms of business performance. Their stocks might not do as well. So the ETF price might go down, but at the same time, the business tends to do okay. And what that brings us is good business performance that then later can turn into stock price going up. And if that happens, of course, looking at an ETF perspective, I think it's easier. So it's very difficult, by the way, to pick up single stocks and be right about all of them. But when you're looking at an ETF, you're looking at a collection of stocks. So even if one or two of them fail, it's going to be just fine. So for example, if you look at VDC, the top 3 holdings are Procter & Gamble, PG, which is amazing, a huge company. Next one is Coca-Cola, and the third one is PepsiCo. So looking at consumer staples, it makes sense to look at an ETF in this case. Now, you might ask, what should you choose? In my opinion, choose either one of these depending on what kind of liquidity you want. Usually when we are investing in index funds, or when we are investing for the long time, we don't need immediate liquidity. But if you want, I can give you my example. I go with ETFs, and just because of the fee structure, I think the fee structure is a bit cheaper if we talk about ETFs versus mutual funds. So I go with that, be it in the Indian markets or be it in the United States market. This is an ETF that I SIP into or DCA into regularly every single week. I also look at Vanguard S&P 500 ETF. I also invest regularly in the QQQ trust. Now this one, again, as I said, about 48% tech stocks. So I can get an indirect exposure to tech through QQQ, although it is not supposed to be a tech only or a tech dependent ETF. So this is how you can think about index funds or ETFs. Do let me know if this video leaves a couple more doubts in your mind. If it does, I'll try my best to clear those in upcoming videos. I hope you like these videos. I hope you get some information out of these videos. If you do, make sure to smash that like button and click unsubscribe if you want to see more videos from me in the near future. I will see you guys next time. Thanks for visiting Crypt-Economy, guys.